Hello everybody, my name is Mark and it is time for me to do another video. This video I am going to talk about moving averages and how you can use those to help you make money in your overall investing strategy. So without further ado, let's get started. So here I have Apple stock, and let's go to the charts and let's look at Apple stock. So Apple stock has a very nice looking chart. Over the last 5 years, they've had some dips, but you can see going back 5 years, they've gone up quite a bit. Back in 2013, they were down as low as $60. And if we go further out, let's say 10 years, look at that chart. Apple stock was a piddly $20 stock, and now they're pushing $153. Wow, that is quite a return on your money, right? But there's always a risk of losing money, isn't there? So that's where the moving averages come in. So let's pull up the 200-day moving average, simple moving average I will use here. Let's do this. 200. Actually, let's just make it one line. How about that? We'll just pull up the 200-day moving average. And there is the 200-day moving average. So Apple is way the heck above the 200-day moving average. Let's see. The 200-day moving average is this green line down there. Get out of that. And Apple is way the heck up here, so that's way above the 200-day moving average. But you don't have to use a 200. I guess in this situation, I might use a shorter moving average. I might use a, let's see, let me draw a new trend line here. Let's see. Let's go to maybe a 90-day moving average. How about that? Let's put in the 90-day moving average, and let's see what that one looks like. There, that one's a little bit better. And the only reason I switched to a 90-day, normally the 200-day moving average is the litmus test of stocks and investing, but Apple's so far above it, I decided to switch to a 90-day. The purpose of the moving average is it kind of gives you a line in the sand where if the stock drops below that, then you sell and you get out of Dodge. A moving average is a derivative of the price. It is a mathematical derivative, and it's, in this case, it's this green line here. And right now, let's go to a shorter time frame. Let's go to a year. So right now, it looks like the 90-day moving average is right about there. It's right at about $140. So what that means is over the last 90 days, which would be from this point, there to there to there, that's 60 days. So over that period, which would be from about there to there, this green line right there is a mathematical computation or mathematical derivative of all of that right there. If I wanted to, I could switch to a shorter day and it would get higher and higher. So let's go to 25 days and let's exit out of that so you can see. And you can see now the line gets closer and closer to the actual price of the stock. If I were to put like 2-day moving average, which I don't think I would ever go that short, then the line, you can hardly tell that there's even separation. You can see right there is a little green line, but there's hardly even separation. So let's go back to the 90-day. Okay. Now, whether you use a 90-day moving average or a 200-day moving average, the point is to use kind of a longer moving average, which gives you kind of a big picture of the direction of the stock or the market, okay? And this particular strategy is for people that are long-term investors. They want to buy and hold stocks for many years. in good, strong companies like Apple or maybe Netflix or Amazon or Google or any of those, you would plug in one of these longer moving averages, and then if the stock ever dropped below that moving average, then the suggestion that I'm giving is to sell out and wait till it goes back above that moving average. So in this case, Apple right there, and right there are the only places where it dropped below. And then earlier it looked like it dropped below there. So I would say don't buy Apple until here, okay, until it goes up, and then it goes up. So you would buy, looks like at about $100 a share, and then here you would sell out at 110, and maybe you would buy back in if it dipped above, and maybe you'd sell out, but then you get back in here and you would have made money all the way from $110 to $150. So you would have made $40 a share. Okay, so the moving average is a very good, and there's many ways you can use moving average, but it's a very good line in the sand that you can draw to protect yourself, and so that you don't lose money in case there's a recession or something. So that's if you are a long-term investor. Now let's say that you are a more aggressive short-term investor and you want to try to make more money. You want to try to make the big bucks, right? Well, first thing you do is you want to look for a stock that is volatile. If you're going to be a swing trader or a day trader, then you want stocks that are moving like rock and roll, right? Like roller coasters. So here is a stock. It's actually an ETF. It is a leveraged ETF, NUGT, Nugget, and it is leveraged 3x against the gold mining stocks. Okay, and let's pull up the chart and you will see what I mean. Now this is over the last year, and I will go back to my trend lines here. Now look at the volatility of this. Okay, this is just in the last year. So in June, that was at $60. Okay, and then over the next 3 months, from there to there, it went all the way up to there. So it went from $60 to $140, and then it crashed back down to $80 with some ups and some downs, and then it went down lower back to the 50 or 40, and then it just keeps going lower. And one thing I want to say about leveraged ETFs is that they lose value over a long time period. They are mostly designed for the short-term performance, and I want to just go to the summary right here. If you were to pause the video and read all of that, okay, pause the video and read all of that, you will see that it is right here. The investment seeks daily investment results of 300% of the daily performance. So I want to highlight that part, daily, okay? People that invest for the long term in a leverage fund like this are making a mistake, in my opinion, because the leveraging means, let's see if it even says. Well, I'll just tell you that when funds like this are leveraged, they use calls and puts and straddles and strangles and swaps and shorted positions and all sorts of stuff just to get that 300% return. And every single day, those contracts are rebalanced to try to get the 300%. I'm getting a little off track here, but back to the chart and back to the moving average. So the volatility is pretty crazy here. Now, even at this part right here, from December to the current time right now, today is May 24, 2017, even from those short little 5 months, okay, let's go to a 6-month chart and you'll see what I mean. This is the volatility in just the last 6 months. Okay, so here in December, it looks like it was right at $30, and then it dropped down to like the 20s, and then it went to 30, and then it went to 40, and then it was up to 50, and then it went back to 40 and then to 30. Now keep in mind that these moves, like a move from like $30 to $50, that's a 66% move. Okay, so here we are at $30, and then we're back up to $40, and we go to $45, and even just from $40, let me clear that, and now let me put this back in. Even just from $40 to $45, that's a 10% return, and that's all in about 2 weeks. How about making 10% return in 2 weeks, right? And then it drops back down, and that would be good if you were to short sell it, right? So that's just to show you the volatility. So this is what you want if you're a short-term trader. So going back to the 1 year chart, okay? Now, the golden question that every investor or day trader or swing trader, whatever, wants to know is, how can I capture the lion's share of these moves? Like, if I would have known, if I would have short sold up there and then bought the cover there, I mean, I would have made a boatload of money. That's $60 a share, right? Or if I would have like bought down here and sold up there, let's see, $60 up to $140, I would have more than doubled my money. So that's the golden question we all want to know. How can we capture the lion's share of this? Even if we don't get it all, even if we just get some of it, you know, we can make good money. That's where the moving averages come in. So let's go back to our moving averages. And I'm going to use 3 moving averages instead of 1, because we're not long-term investors anymore. We are now short-term investors trying to make some bucks. Okay, so first let's put in a 5-day moving average. And that is a short, let me clear out these trend lines. Okay, that is a short-term moving average. And now I'm going to go to a shorter chart. And I'm going to go to a 10-day chart, so you can see here. Okay, now this short-term moving average almost moves with the price of the stock. Okay, there are some upticks where it goes a little higher, like way up there, but the purpose of this short term is that it tells you what the immediate action of the price is. It measures momentum. Okay, in other words, people are getting excited and there's something going on. Like, look at this big, ugly red candle here. Gold took a big hit that day for whatever reason. That was back in May 18th, about not that long ago. Okay, and it went down. And this, ladies and gentlemen, is a 10-day chart. So up here, today's May 24th. But up here on May the 17th, it was at $38, and then now it dropped down to the $32 level. That is a $6 move. That is almost a 20% move in the downward direction, which is great for short sellers, but not so great for the long positioners. But imagine if you would have bought here on May 12th and then sold out here. You would have made that 20% return, right? Almost 20%. Anyways, so first you put in the short-term 5-day moving average, and that is your signal to buy. Okay, and the plan is that whenever the stock goes above that moving average, it's time to buy. Okay, now you don't want to go by that exclusively because this thing is going crazy, right? So you want to put in or add a kind of a middle or a midterm moving average, and we'll put in, let's just put in an arbitrary number. How about 30-day? Now let's do 25-day chart. Okay, and there's a 25-day. Now this blue line here is a longer moving average, so it's a little, the price of this, here, let me clear out these trend lines again. Okay, now I'll go back to the trend lines. Okay, so the price of this ETF, you see, gets further and further away the longer or the more days you go out. So the longer that the moving average is, the more of the big picture it helps you to see. Okay, so the green line, that was your short term, and the blue line, this is the one that you use for your stop loss. Okay, so the green line tells you the short term moving average tells you time to buy. Okay, but you never, if you're especially if you're a day trader, but really if you're any kind of short-term trader or investor, you never just want to buy and not use a stop loss. You always want to put a stop loss in because the market by nature is unpredictable. Nobody knows the future, and so that's what the stop loss is for. So in just the last 10 days, okay, you would want to wait for the price of the stock to go above the green line. Okay, And let me pull up the trend lines again. And so right here, maybe you would buy, and then you would just hold on to the stock, and the blue line would be your stop loss. Okay, so you would hold, and you wouldn't sell here. I mean, I guess if you had a magic crystal ball, that would be the time to sell. But if you were to just use the rule of using the blue, then you would have got out there, because that's where it went down. And so you would have bought Nugget at about $35, and you would have sold out at $37 a share, making $2 per share. So if you would have got 100 shares, you would have made 200 bucks. Okay, that's not bad. Okay, and again, right here's the same thing. Right here, you would have made some, you would have bought in at 35, and then your stop loss being the blue line. So the blue line is your support. That tells you, okay, it gives you a longer time frame, and that's your support. So the green line tells you time to buy, and the blue line tells you time to get out. Now, I'm going to add one more moving average, and we'll put in, let's see, how about 100 days? 100 days update chart. Okay, so now I want to look at the longer chart real quick here to make sure I've got the right. Okay, well, I guess that's good enough. Might not be the perfect, but the point is you use the longer one, and this one is your trend line. Okay, this one is a 100-day moving average, which is a mathematical derivative of the price of Nugget over the last 100 days. Okay, and that line tells you whether to go long or whether to go short. If the price of the stock is above this 100-day moving average, then you go long. So up here would be your long days, and here it would be your short selling days. And now here, well, I guess over there is like nail biting time, right? It could go either way. Let me go back to the shorter term here. 6 month. Yeah, so one of the things I will say about this short-term trading and investing is that it's not always the right thing to do to be in the market. Okay, so as I'm looking at this chart here, and I'm looking at how darn close the price is to the 100-day, I don't even know I would mess with it right now. I would wait until there's a little bit of distance there, because it looks like it's barely below. I guess if you wanted to, you could short it. And I think in general, if you were going to be a short-term trader or investor, you'd want to short, especially on these leveraged ETFs, you'd want to be a short seller, because these leveraged ETFs are designed to lose money over the long haul. They're only good during the day trading. So I guess something like this, you would want to maybe try day trading. Okay. So back to the 10-day chart, as I look at this, it looks like the price is below the 100-day. So that means I want to go short, okay? And then I would want to wait. I'm even going to go to a shorter time frame. I'm going to go to a 5-day. All right. Now I'm getting a better picture here. Draw up the trend lines, and let's see where we're at right now. Yeah, see, right now I would wait to see what the price of Nugget does, and if the price were to go below this green line again, then I would short sell it. I would not go long. I would short sell it. So number one, the price of Nugget is below the 100-day moving average. That's your trend line. That tells you whether to go long or short. Okay, the green line, that's your short 5-day moving average. That tells you whether to buy or sell. And the blue line is your support or resistance. Okay, that tells you when to stop loss or when to get out. Okay, so short-term investing and trading is certainly a lot different than buying and holding for the long term. Probably the easiest thing to do if you're just starting out is to pick a more stable stock. Maybe go to a stock like Apple, or let's see, let's pick a utility stock. Let's go to General Electric and let's check that one out. And let's go to the chart here. And let's get rid of these moving averages and just put in our long-term 200-day moving average and see what it looks like. And now let's go to a long-term picture of General Electric. And there you go. This is a long, and it looks like the price of General Electric. Let's even go longer here. This is a great example. This chart is a great example. So if you would have followed the rule of the 200-day moving average, you would have saved yourself a boatload of money. You would have got out right there, and then General Electric would have proceeded to tank, right? And that would have saved you about $30 a share, which would be nice, right? So 200-day moving average strategy is designed to protect the long-term investor from losing lots of money if there's a recession or a bear. And if the price of the stock goes below, so you pick a company, you pick a stock that you like, and you say, I'm going to buy it. And then you use the 200-day moving average as your rule, whether you want to get in or out. If it goes below, you get out. And let's go back to the shorter term here. Let's go to a year. How about that? So wow, this is interesting. So the price of General Electric stock is going up here. So I guess if you were to use that rule, you would have bought here, and then you would have sold here. You would have bought there, and then you would have sold out there. And I guess you would still stay out, right? If you're going to stick to the 200-day moving average rule, I guess you would want to wait for General Electric to go back above that 200-day moving average. So it's a very good long-term strategy for the long-term investor. If you're the short-term investor, you can kind of mix and match what moving averages you want to use and what strategies you want to use. There's no exact science to this. This is more of an art or a personality thing. Okay, Nugget. Interesting that Nugget at one time was above its 200-day moving average here at the beginning. It looked like in the middle of last year. So, anyways, this is a basic example on how you can use moving averages. Moving averages are lines in the sand that you can draw, and they tell you when to get in, when to get out. They tell you when to buy. They tell you where to set your stop losses. You can use them to tell you whether to go long or whether to go short. So thank you for watching this video. That's it for this video. I hope you were able to keep up with everything I was talking about. I realize I ramble a lot, but I enjoy this stuff. I think technical analysis is very useful in the world of investing, and I will see you in the next video.